Welcome to the complete guide to support and resistance, the most powerful tools in technical analysis. In this video, you'll learn everything from basic concepts to expert-level strategies. We'll break down how traders use these levels to enter, exit, and manage trades. By the end, you'll be able to analyze charts with confidence and clarity. Support is a price level where the market tends to stop falling and starts to rise again. It forms when buying pressure overcomes selling pressure at a particular price. Think of it as a floor that holds up the price during a downtrend. Traders often look to buy when price approaches support. Refer to the chart on the screen to see how support levels have formed. Resistance is the opposite of support, a level where price struggles to go higher. It occurs when selling pressure is strong enough to stop the market from rising. You can think of it as a ceiling that blocks upward movement. Traders use resistance to take profits or enter short trades. Check out the chart to see clear examples of resistance levels in past market action. Support and resistance are critical to identifying key market turning points. They help traders know where to enter, where to exit, and where to avoid trades. These levels exist in all timeframes and in every market, stocks, forex, or crypto. Mastering them gives you a huge edge in technical analysis. The chart on the screen highlights how price reacts to these key levels. Support and resistance are created by trader behavior and market memory. Buyers remember price zones where price previously reversed upward. That's support. Sellers remember where price struggled to go higher. That's resistance. These areas reflect crowd psychology, fear, greed, and reaction. Take a look at the chart to see how these patterns repeat across different markets. Not all support and resistance levels look the same. There are horizontal levels, trend lines, moving averages, Fibonacci zones, and more. Each type works differently depending on market conditions. Understanding each kind will help you adapt to different strategies. The images on the screen show visual examples of each type. Horizontal support and resistance are the simplest and most widely used. They are drawn across previous highs or lows where price reacted strongly. These levels act like solid floors or ceilings in the market. They're especially effective in sideways or ranging markets. Refer to the image to see how horizontal levels are drawn and respected. Trend lines create diagonal support or resistance based on the market's direction. They're drawn by connecting higher lows in uptrends or lower highs in downtrends. These sloped levels help identify where pullbacks may end. A break of a trend line often signals a change in trend. Check the screen to see clear examples of trend lines in various market conditions. Moving averages act as dynamic support or resistance, following the price as it moves. The 50-period exponential moving average and the 200-period simple moving average are the most commonly used. Price often bounces off these lines, especially when confirmed by candlestick patterns. Watch the screen to see how price reacts to moving averages in action. Round numbers like 100, 1000, or 10,000 often act as psychological barriers. These levels become magnets for price and major decision points for traders. Institutions and retail traders often place orders around these zones. Psychological levels aren't visible indicators, but they're extremely powerful. The images on the screen show how price reacts near key round numbers. Fibonacci retracement levels often align with support and resistance zones. Traders use levels like 38.2%, 50%, and 61.8% to predict where price may reverse. These levels are especially useful during pullbacks in a trending market. They work best when confirmed by price action or other S&R. Refer to the chart to see how Fibonacci tools align with market structure. Past highs and lows are some of the most reliable support and resistance zones. When price revisits these levels, it often reacts strongly. A previous high can become future resistance, and a low can become support. This concept is simple but incredibly powerful. Look at the screen to see how historical highs and lows influence future price movement. A level becomes stronger the more times price touches and respects it. The longer a level holds, the more traders trust it. Strong levels are often zones of high volume or major price reaction. Use these for high probability trade setups. See the chart to understand what strong support and resistance levels look like. Support can turn into resistance after a breakdown, and vice versa. This is known as a flip or roll reversal zone. It shows that market sentiment has shifted at that level. These are great spots to look for trade entries. Refer to the image to spot classic examples of flip zones. When price breaks through a support or resistance level, it can lead to strong moves. Breakouts show a change in supply and demand dynamics. Look for volume and momentum to confirm real breakouts. Breakouts can lead to new trends or strong continuation patterns. The chart on screen shows past breakout scenarios and their outcomes. Not all breakouts are real, some are fake outs that trap traders. Price briefly breaks a level, then reverses sharply. These traps are often created by big players to stop out retail traders. Wait for confirmation before acting on a breakout. Look at the chart image for clear examples of fake outs in the market. Support and resistance are not precise price points, they're zones or areas. Price can go slightly above or below before reacting. Drawing them too tightly can lead to false signals. Allow some flexibility when analyzing these levels. Refer to the chart to see how price behaves within zones rather than exact lines. Candlestick signals add powerful confirmation to support and resistance levels. Look for hammers, pin bars, engulfing patterns, or dojis at key zones. These patterns show rejection or strength from the level. They help you decide whether to enter or stay out. The chart shows examples of candlestick patterns forming at key support and resistance areas. When the market is ranging, price bounces between support and resistance. This creates a sideways structure ideal for swing trading. Buy near support, sell near resistance, and avoid the middle. Wait for price action confirmation before entry. Refer to the screen to see a clear example of a range-bound market. In trending markets, support and resistance behaves differently. Support becomes dynamic and moves upward in uptrends. Use moving averages or trend lines to guide entries. Enter on pullbacks near support, and ride the trend. Check the image to see how support and resistance plays out in trending conditions. Support and resistance help you place accurate stop loss and take profit levels. Put stops slightly beyond support or resistance to avoid being wicked out. Take profits near the next opposite level. This improves your risk-reward ratio and protects capital. The chart shows ideal stop loss and take profit placements based on real setups. Do not clutter your chart with too many lines. Focus on the most obvious levels, the ones where price clearly rejected in the past. It is best to use just 2 or 3 high-quality zones per chart to keep your analysis clean and focused. Remember, consistency and simplicity often lead to the best results. The image on the screen shows both correct and incorrect ways to draw support and resistance levels. Confluence means combining multiple tools or signals in a single trading setup. For example, support combined with a candlestick pattern and a Fibonacci retracement level creates a high probability trade. The more confluence you have, the higher your chances of success. It helps filter out low-quality trades and gives you more confidence in your decisions. Refer to the image on the screen to see real examples of confluence in action. Congratulations! You have officially leveled up your trading skills. You have now completed the full journey through support and resistance, from the foundational concepts to advanced strategies used by professional traders. Well done, you're now one step closer to trading with confidence and consistency. Next up, market structure mastery, one of the most powerful tools in technical analysis. You'll learn how to spot trends, identify swing highs and lows, and master concepts like break of structure and change of character. Don't miss the next video, it's where everything starts to connect.